Hello, class, and welcome to Chapter 11, Project Evaluation or Project Analysis and Evaluation. Learning objectives for this chapter include perform and interpret a sensitivity analysis for a proposed investment, perform and interpret a scenario analysis for a proposed investment, determine and interpret cash, accounting, and financial break-even points, explain how the degree of operating leverage can affect the cash flows of a project, and discuss how capital rationing affects the ability of a company to accept projects. Some of the outlines include evaluating NPV estimates, scenario and other what-if analysis, break-even analysis, operating cash flow, sales volume, and break-evens, operating leverage, and again, as well as capital rationing. Evaluating NPV estimates and estimated NPV is positive, is a good sign. We know that. But more than anything, this tells us that we need to take a closer look. Projected cash flows are not likely to equal actual cash flows. These are estimates. That's a key point in a lot of the exercises that we've been doing up until these points, is that everything that we've talked about is we're trying to make reasonable estimates and predictions of what the future might look like really for any project that we cover. When we say something like the project cash flow year 4 is 700, what does that mean? We have, no idea if year 4 is going to generate 700. These are estimates. If you recall from chapter 10, I talked about an example where, an analyst inside Apple might say, all right, we assume that 1 out of every 8 iPhone users will buy an Apple Watch and 1 out of 4 will buy a pair of AirPods. That's what they believe will happen, but it might not be what will actually happen. This is called forecasting risk, or an estimation risk. It's a possibility or almost guarantee that errors in projected cash flows will lead to incorrect decisions potentially. Source of value answers the question, what is it about investment that leads to a positive NPV? The first line of defense against forecasting risk. Key factors to keep in mind are degree of competition and potential competition in the market. You're creating a new product or project that you think will be revolutionary. How do you know that other companies aren't going to do the same thing and potentially flood the market? We've seen this with weight loss drugs currently, Ozempic and Wegovy by Novo Nordisk and Eli Lilly. If there's one product on the market, they can charge whatever they want. 2 products is going to be competition. 5 products that compete for weight loss, the product's price is going to be in free fall. One other comment I'll make on this as well is in regards to how even Nvidia may interpret their cash flows or their projected profits. Nvidia looks inexpensive on some metrics and less so on others. The first thing to do when investigating a new project NPV estimate based on projected cash flows, initial set of projections are called the base case. After completing the base case, we can investigate how different assumptions about the future will impact estimates. One way to do this is by putting upper and lower bounds on various components of the project. You might say, a base case, a bear case, or a bullish case, or a lower bound and an upper bound case. Project under consideration costs $200,000, has a 5-year life, and this has no salvage value. Depreciation is straight line. The required return or discount rate is 12%, and the tax rate, which becomes a tax shield, is 21%. In addition, we have compiled the following information. I will not read the specific data here, but basically, there is, what is the unit sales, right? And the price per unit in each case. And then variable costs also rotate in all of these different scenarios. You can see the lower bound, the variable cost is lowest, the price is also lowest, and the sales volume is lowest. With this information, we can calculate the NPV base case by first calculating net income. This was done in the prior chapter. Operating cash flow is 30,000 plus 40,000 minus the 6,300 for a total of 63,700 per year. At 12%, the 5-year annuity factor is 3.6048. I would always recommend, as we've discussed in class, actually using your financial calculator. I think that's easier than using the annuity factors. Um, so the NPV base case is negative 2,000 plus the 63.7 multiplied by that annuity factor. This can also, again, be done with your financial calculators that we've discussed. Scenario analysis is the determination of what happens to NPV estimates when we ask what if questions. What if the sales are lower? What if our costs are higher? What if the price is lower? What if the price is higher? So you get a broader range of outcomes to help determine whether this is a good or bad project. We can consider the number of possible scenarios, but let's start with worst and best case. For our project, these would include the following. And again, we're getting a best and worst case scenario. We can now calculate the net income and cash flow for each scenario. And, for this project in particular, some of the takeaways are that the base case, it's going to have an IRR of 17.8 and a best case IRR of 47.9, which is a fantastic number. In a bad case, it's negative 17%, with a negative NPV of negative 122K. Scenario, another what if analysis. So talking about sensitivity analysis is the investigation of what happens to NPV when only one variable is changed. So you can look at the same scenario and just look at changing one variable instead of changing multiple variables. Returning to our base case for every item except unit sales, we can calculate the cash flow and NPV using the largest and smallest unit sales figures. We can freeze everything except fixed cost and then repeat the analysis as seen below. Results of sensitivity analysis for unit sales can be illustrated graphically as well. NPV on the vertical axis and unit sales on the horizontal. When we plot combinations of unit sales versus NPV, all possible combinations fall in that straight line. The steeper the line, the greater the sensitivity of estimated NPV to changes in projected value of the variable being investigated. So how sensitive is it to a change in variable? One conceptual example that comes to mind is, just again, something in our daily lives is how sensitive is our driving to gas prices, right? And you might say, hey, between $1 and $10 a gallon, we drive the same amount. But the second it goes above 10, we might reduce our driving, we might carpool, the changes might become very sensitive. You can do simulation analysis. This is a combination of scenario and sensitivity analysis, wherein we allow all items to vary at the same time. With scenario analysis, we let all variables change, but we let them take only a few values. With sensitivity analysis, we let only one variable change, but we let it take on many values. In its simplest case, we start with unit sales and assume that any value between 5,500 and 6,500 is equally likely. Start by randomly picking one variable and then randomly selecting a price, a variable cost, and so on. For some of you guys might have heard the term Monte Carlo analysis. This is, beginning the concepts of some of that, which is running a simulation of multiple hundreds or sometimes thousands of potential outcomes within a range. You repeat this sequence as many times as desired, probably several thousand times. Again, that's the Monte Carlo analysis, even though it hasn't mentioned it here. The result in many NPV estimates that we summarize by calculating the average value and some measure of spread out the different possibilities are. How spread out are those values? And again, this is an important concept because you want to know the best and worst cases. Because in reality, what can happen? Hey, your materials cost might rise, right? Your labor cost might rise. Maybe your material costs rise and your labor costs fall. Maybe materials drop, labor rises, but unit sales fall. A lot of these can take different shapes and sizes, just like in real life. Fixed and variable costs, break-even analysis is popular and commonly used tool for analyzing the relationship between sales volume and profitability. I know this doesn't directly apply to, this concept in terms of a project, but looking at like what your break-even analysis is. So in my line of work, a client with $200,000 in assets, probably comes in at a 30% profit margin to break even, depending. Because, when I have a client that has $200,000, if they have one account, my profit margin on that, is probably 50%. But if they have four accounts with 200,000, my profit is probably zero, right? Um, and that's because of the impact of fixed and variable costs. In wealth management, just because that's my area of expertise, all our variable costs come in the form of how many accounts we have. You're more profitable if you have fewer accounts and more money than more money with more accounts. The relationship between total variable costs, cost per unit, and the total quantity of output can be written as total quantity of output multiplied by the cost of unit output. As you get larger, if your business has scale, costs will drop as as you increase volume. This is because you're getting more efficiency out of your fixed costs. In my line of work, if I have a Bloomberg terminal that costs $30,000, it doesn't matter if I have one client or 1,000. But if I'm looking at that fixed cost and making an average fixed cost, my average fixed cost is going to be pretty damn low if I have 1,000 clients. I take that $30,000 Bloomberg fee, I divide it by the 1,000 clients. The Bloomberg cost is, $30 per client. If I have two clients, my Bloomberg fixed costs are going to be 15,000 per client. You can also think about, rent on or the cost of a new Shake Shack, right? That cost is the fixed cost. You're better off flipping 1,000,000 burgers out of that new Shake Shack than you are 1,000. Why? Because of the fixed cost of that asset and the rent and the building. Suppose variable costs are two per unit. If the unit output is 1,000, the variable cost is going to be 2,000, as shown in the numbers below. Fixed costs do not change when the quantity of output changes, just as I gave in the example before. Your total costs is a function of variable plus fixed cost. And your variable cost is your volume, your price, plus multiplied by the quantity. A variable cost is $3 per unit and fixed costs are 8,000 per year. Our total cost is 3 multiplied by quantity plus 8,000. If we produce 6,000 units, our total production cost will be 3 times 6,000 plus 8 for a total of 26,000. And you can see a chart of different cost structures below, meaning if we produce nothing, we have fixed costs of 8 grand no matter what. You can often sometimes refer to that as potentially a sunk cost. By applying the point from where the table in the previous slide, we'll see that the relationship between the quantity produced and total costs is given by that straight line. Notice that total costs equal fixed costs when sales are zero. And you see that in the straight horizontal line below. Beyond that, every 1 unit increase in production leads to a $3 increase in total costs. So the marginal incremental cost of producing one more unit is just $3. Average versus marginal cost. Now, this is a concept you guys might have seen before in some finance or accounting classes, but suppose that the corporation has variable costs of 55 cents. The lease payment on the production facility, which is going to be a fixed cost, is 5,000 per month. If they produce 100,000 pencils per year, what is the total cost of production? What is the average cost per pencil? And we see that below with the same formula, V times Q plus fixed cost for $115,000. The average cost per pencil then is $1.15. That's a pretty expensive pencil. You would want to, in this case, be producing way more pencils to drive down that cost, to something that's more affordable. I don't know what the going rate for a pencil is, but I imagine it's certainly below $1. If Bloom can get 75 cents per pencil in this order, should the order be accepted? And I would say, probably not. What this boils down to is simple. If it costs 55 cents to make another pencil, anything Bloom can get for this pencil in excess of 55 cents in incremental costs contributes in a positive way. The 75-cent marginal or incremental revenue, in this case, it's incremental, so you would accept that. The fixed cost of $60,000, remember, that's considered a sunk cost, so it's irrelevant to the decision because it's a sunk cost, at least for the current period. In the same way, the fact that the average cost is 115 is irrelevant because this average reflects the fixed cost. As long as producing 5,000 extra pencils truly does not cost anything beyond 55 cents, then Bloom should accept any price above 55 cents. This is helpful when considering like what new business to potentially take on, right? You might have higher fixed costs, but the next incremental piece of business, even if discounted, may be worth taking on as a firm. Accounting break even, most widely used measure of break even analysis in accounting. The sales level of that results in zero project net income. Like, what do we need to make, to break even? Not make money, not lose money. Suppose that we retail one petatype computer for $5 a disk. We can buy disks for wholesale at 3. We have accounting expenses of 600 in fixed costs and 300 in depreciation. How many disks must we sell to break even for net income to be zero? So for every disk we sell, we pick up $5 minus 3 for $2 toward covering our other expenses. That is contribution margin of per unit is $2. We must cover a total of 600 plus 300 equals 900 in accounting expenses. So we need to sell 900 divided by 2, 450 disks to break even in this example. We do not consider any interest expense in calculating net income or cash flow from the project. In the accounting break even, we include depreciation in calculating expenses. When net income is zero, so are pre-tax income and, of course, taxes. So when doing break-even analysis, this will be a good multiple choice question in the future. What are the taxes? They're going to be zero. You're breaking even. In the graph, total revenues are zero when output is zero. Beyond that, each unit sold brings in another $5. So the slope of that revenue line is 5. Break even occurs where output is equal to 450. Taking a closer look, break even is equal to the sum of fixed costs and depreciation divided by price per unit less variable cost per unit. Break even level may be solved for using the following. Sales minus variable cost equals fixed cost plus depreciation, or redefined as quantity equals fixed cost plus depreciation divided by selling price minus variable cost per unit. This will get you the same answer. What are the uses for accounting break even? Why would anyone be interested in knowing accounting break even? Well, again, it might help you in determining when it would be a good idea to take a project. Accounting break even and payback period are similar measures. Like payback period and accounting break even is relatively easy to calculate and explain. Managers are often concerned with contribution a project will make to the firm's total accounting earnings. A project that does not break even in an accounting sense actually reduces total earnings. A project that just breaks even on an accounting basis loses money in financial or opportunity costs. Would you rather take a project that breaks even or one that makes money or one that doesn't, guarantees you to lose money? Break even, you might have been better off putting that money in a savings account. Operating cash flow, sales volume, and break even. Westway Sailboat Corporation is considering whether to launch its new boat. The selling price is $40,000. Variable costs are $20,000. Fixed costs are $500,000 per year. That's probably the factory or whatnot. Total investment need to undertake the project is $3.5 million, which will be depreciated over a 5-year period. The salvage value is zero, making some of this easier to calculate, and there are no working capital considerations. The required return or discount rate is 20%. Westway projects total sales for 5 years to be 425 boats, or about 85 boats per year, ignoring taxes, should the project be launched. So first, that same formula we just did, EBIT plus depreciation minus taxes. So you have the 85 multiplied by 40,000 times the minus 20,000 minus the 500,000 is $1.2 million a year at 20%. And again, as I previously mentioned, I would use the NPV with the financial calculator and not the annuity factor. And effectively, the NPV would equal $88,735. Before fixed costs and depreciations are considered, Westway generates about $20,000 per boat, which is revenue less costs. Depreciation is $3.5 million divided by 5 for about $700 per year. Fixed costs and depreciation together total $1.2 million. So Westway needs to sell, again, that formula we saw previously, $1.2 million divided by 20,000 equals 60 boats per year to break even on an accounting basis. To calculate the cash flow in this case, we note that if 60 boats are sold, net income will be exactly zero. Recall that operating cash flows for project can be written as net income plus depreciation, the bottom-up definition. Operating cash flow is equal to the depreciation, or $700,000. Whenever a project breaks even on an accounting basis, the cash flow for that period will be equal to the depreciation. Suppose that we invest $100,000 in a 5-year project, depreciation straight line down to zero with no salvage value, or $20,000 per year. If the project exactly breaks even every period, then the cash flow will be $20,000 per period. Because remember, depreciation is not it's an expense, but it's not a cash flow. The sum of the cash flow for the life of the investment is 5 times 20,000, or $100,000. As shown in the example above, a project payback period is exactly equal to its life if the project breaks even every period. A project that does better than break even has a payback that is shorter than the life of the project and has a positive rate of return, or NPV. A project that just breaks even on an accounting basis has a negative NPV and a zero return. Why? That is due to the discount rate. Ignoring taxes, a project's operating cash flow can be written as P minus V multiplied by Q minus fixed cost. And we have that here as 500 plus 20 multiplied by Q. The relationship between operating cash flow and sales volume is given by a straight line with a slope of 20 and the intercept of negative 500. That is your fixed cost. If we calculate some different values, we see different numbers of operating cash flow. And of course, when we sell 75 of these items, the total operating cash flow is 1,000. We can plot the lines together on the graph below, as seen here. And some of this is straightforward and pretty common sense. Like, if you have a business with scale and you have fixed costs and variable costs, the more you build, the more profitable you are, the higher the cash flow. There's some things that aren't considered here yet. Maybe your variable costs decrease further as you continue to scale. We have shown the relationship between operating cash flow and sales volume. Again, P minus V multiplied by Q minus FC. If we rearrange this, quantity can be written as FC plus operating cash flow divided by P minus V. Looking at the graph on the previous slide, suppose operating cash flow is equal to depreciation. That's going to be a concept that will certainly be quizzed on at the end of the semester. Recall this situation corresponds to break-even point on an accounting basis. Define sales volume, substitute 700 depreciation for operating cash flow in our general expression, and we get $60 for that number. Cash break-even is a sales level that results in zero operating cash flow and is calculated as follows. Q equals FC plus 0 divided by P minus V. They must sell 500 boats to cover the $500 fixed cost. I will have you know that definition. The financial break even is the sales volume that results in a zero NPV. Determine what operating cash flow must be for NPV to be zero. Some of this is dependent on the discount rate. Recall that the required return or discount rate is 20% on its $3,500 investment. How many sailboats does Westway have to sell to break even once we account for that 20% opportunity cost? A 5-year annuity factor, or as I've mentioned before, I would use your financial calculators, would come out to 1170. We can now plug in the operating cash flow in the equation and get 500 plus 1170 divided by 20. For a zero NPV project or a financial break even, we would need to sell 83 and a half boats. Probably would round that up. The general break even equation is fixed cost plus operating cash flow divided by price minus variable cost per unit. As shown, this relationship can be used to determine the accounting, cash, and financial break-even points. The accounting break-even occurs when net income is zero. Operating cash flow is equal to depreciation when net income is zero. So the accounting break-even is quantity equals FC, fixed cost, plus depreciation, divided by price per unit minus variable cost per unit. And this is, again, just summarizing that we've already talked about. The cash break-even occurs when operating cash flow is zero. The cash break-even point is quantity equals fixed costs divided by price per unit divided by variable cost per unit. A project that just breaks even on a cash flow basis never pays back and has an NPV that is negative. And again, that's because the discount rate or required rate of return. And again, the financial break even, these are pretty repetitive, but quantity equals fixed cost plus operating cash flow divided by price per unit minus variable cost per unit. These last 3 slides, I would say, will be needed to be memorized for a future final exam. Operating leverage is the degree which a firm's project relies on fixed cost. A firm with low operating leverage will have low fixed costs compared to a firm with high operating leverage. So a project with relatively heavy investment in plant and equipment will have a relatively high degree of operating leverage. So a car manufacturer has much more operating leverage than a wealth management firm because a wealth management firm doesn't require a lot of equipment while a car manufacturer does. Operating leverage has important implications for project evaluation. Fixed costs act as a lever in the sense that a small percentage change in operating revenue can be magnified into a large percentage change in operating cash flow or NPV. The higher the degree of operating leverage, the greater is the potential danger for forecasting risk. Why? Well, if you start a wealth management firm and you're off by some numbers, you have very little fixed costs. All your costs are variable, so it's still highly probable that you'll have a high NPV project. If you started a landscaping company that required a lot of equipment, or a snow plowing company that required a lot of equipment, and we don't get a lot of snow this year, that high operating leverage or investment into equipment is going to be a huge detractor for you. Degree of operating leverage, or DOL, is a percentage change in operating cash flow relative to the percentage change in quantity sold. It is defined as DOF equals 1 plus fixed costs divided by operating cash flow. Going back to the Wesley example, OCF is negative 500 plus 20 multiplied by Q. Suppose that we have 50 boats. At this point, level of output, OCF is 500 minus 500 plus 1,000 equal a positive 1,000. If the Q rises by 1 unit, then the percentage change is 51 minus 50 divided by 50, or 2%. OCF rises to 520. A change of P minus V equals 20. The change in OCF is 520 minus 500 divided by 500, or 4%. A 2% increase in the number of boats leads to a 4% increase in operating cash flow. And again, if you simplify this, this is because when you produce more, each additional unit is more profitable because it drives down the average fixed cost. We can verify DOL is exactly 2 by noting that it equals 1 plus fixed cost divided by OCF, and we get the same answer. Suppose Q rises from 50 to 75, a 50% increase. DOL will equal 2. Operating cash flow should increase by 100% or exactly double. Does it? Um, Notice that operating leverage declines as output rises. For example, at an output of level of 75, we have a DOL of 1.5. Another example of operating leverage. This company sells gourmet dog food for $1.20 a can. Variable cost is 80 cents per can, and the packaging marketing operations have a fixed cost of 360,000 per year. Depreciation is 60,000. What is the accounting break even? Ignoring taxes, what will be the increase in operating cash flow if the quantity sold rises 10% above the break even? The accounting break even is 420 divided by 40 cents, and that's 1,050,000 cans. As we know, the operating cash flow is equal to the 60,000 depreciation at this level of production. So the degree of operating leverage is 1, again, DOL 1 plus FC divided by operating cash flow. In this case, it's 7. Given this, a 10% increase in the number of sales will result in a substantial or 70% increase in cash flow. Taking a step back, think about, the cost of running Netflix and the benefit of each additional subscriber, right? It doesn't cost Netflix. They may have to make huge initial upfront investments, but each additional new subscriber provides a ton of leverage on cash flow. Here's another example, just going through, checking that example. So 1,050,000 cans multiplied by 1.1, ignoring taxes, the operating cash flow is going to be 102,000 compared to the 60,000 cash flow we had. This is exactly 70% more. Operating leverage and break evens. At Q of 85 boats, the degree of operating leverage for a sailboat project is that same formula, which I will have you memorize in the future. 1 plus fixed cost divided by operating cash flow equals 1.42. Recall that the sales of 85 boats was 88,735, and the accounting break even was 60 boats. Westway could subcontract production, which would decrease the necessary investments by 3.2 million, decrease the fixed operating costs to 180,000, and increase variable cost to 25,000 per boat, resulting in the following: 74,720 MPV, accounting break even at 55 boats, and operating leverage of 1.16. This option results in slightly lower estimated NPV, and the accounting break even falls to 55 boats from 60. And why did they mention that here? Because you're subcontracting a component of the boat. When you subcontract, you don't need to make the capital investment. Someone else is doing this. Capital rationing, which brings us close to the end of the chapter, exists if a firm has positive NPV projects but cannot find necessary financing, meaning you have limited capital and you can't just finance everything with a positive NPV. You'll want to find the best NPV or the highest NPV. Soft rationing occurs when units in a business are allocated a certain amount of money for capital budgeting. You could have a large company and your business unit might be in favor and more money might go its way, or the opposite. The corporation as a whole is not short of capital. More can be raised on ordinary terms. If the face of soft rationing, the following would be considered: try to get the larger allocation. If a larger allocation is not awarded, generate as large as NPV as possible within the existing budget. Hard rationing occurs when a business cannot raise financing for a project under any circumstances. DCF analysis breaks down when hard rationing can occur when a company experiences financial distress or the firm is unable to raise capital without violating pre-existing contractual agreements. Some concept questions that we will cover in an exam. What is forecasting risk? Why is it a concern for a financial manager? What are the drawbacks, the various types of what if analysis? How are fixed costs similar to sunk costs, which we talked about this chapter? If a project breaks even on a cash basis, what is the operating cash flow? What is operating leverage? And what problems does capital rationing create for an organization? This is the end of chapter 11. Thank you and see you guys next class.